Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, everybody. Welcome to this Friday edition of Benzinga's Pre-Market Prep. Spencer Israel here with Joel Elconin and Dennis Dick. On today's show, we have some earnings. We have some Buffett accumulating a larger position in Apple. We want to talk about the European banks running into some trouble this morning. And at some point at the end of the show, Joel will disclose his very tight or very closely analyzed Kentucky Derby picks, and I know he's excited about that. So our guest today will be at 8:35. Steve Sears will join us. He is a former Barron's columnist, worked there for a long time, wrote the striking price column. Now he's at Stratifi. He's going to talk to us about his new role as their chief market strategist. Again, that'll be Steve Sears at 8:35. Joel, what is doing this morning in the S&Ps?
Well, we're showing down 6 1/4, but we put in a little premium on the close there. So really, we're not trading down that much. But on the upside, let's keep an eye on 26.36 1/4. That was a high from yesterday. Overnight high right there as well. Finding support's going to be a little tricky on the downside. I like 26.20. That's 5 1/4 points away. We hold that, we're good to go north, but could be slippery if we can't hold that 26.20. Crude, that trading range is just absolutely incredible. Trading up 19 cents at 68, 62, 67. That's a level of the decade for support in crude. Gold in the red by $1.40 at 13.11.30. Silver in the red by just a penny at 16.44. Those are very good movers. They will move off the jobs number, which is coming up in about a half hour. And don't look now, but Bitcoin is knocking on the door of 5 digits, trading up $75. Talking to futures here at 9,750. How you doing, Dennis? You getting ready for the jobs number?
I am always ready for the jobs number, but yes, that is correct. That is what I'm doing right now, getting ready to trade banks because we know the banks move the most on it. Obviously, some of your yield stock plays move off that too. This is going to be our next indication of what the Fed is going to be thinking going forward. So this jobs number are always big and market movers. Concerning though, the only thing concerning is I wonder if they just find a reason to sell it. This market just doesn't look as good as it did a couple of weeks ago. And I know we've been talking with Mark Chaikin, we've been talking with a few people. There's still some bulls out there, but man, I'm concerned here. Are you concerned on the SPY chart? Because I don't like what I'm seeing. I see like a head and shoulders even forming within that old W pattern that we were talking, the big W pattern, the smaller head and shoulders. I'm seeing stocks that, have good earnings and then they fade into the earnings. I'm still concerned. Same concerns as yesterday. And they didn't help. And yesterday didn't help at all.
It's just the market has turned a little bit, as you said earlier in the week, selling rips instead of buying dips, even though you had a major rally yesterday. But man, oh man, I mean, looking at these banks, if you were just to look at like Goldman Sachs and you were to look at Bank of America, you'd be like, yeah. And these were the market leaders. FANG is still hanging in there. Both you and I know from our portfolio, they're not buying value stocks. Yeah. So, I mean, this broad market it's dangerous. And, we're still like 100 points above that February low. But man, oh man, and you mentioned we've already been down there two times. Third time, I mean, that could be the breaker. And I think you get a lot more people exiting out of the market if you break that February low.
I mean, we've got some good stories, and Apple is a good story here, and it's a better story here this morning. And if you're wondering why Apple's trading up another $2, you can thank our buddy Warren Buffett because he was on CNBC disclosing to Becky Quick that he has bought more shares. Spencer, how many more shares did Buffett accumulate of Apple?
Yeah, he bought 75 million more shares in Q1. That brings his total up to 240.3 million shares of Apple in the Warren Buffett portfolio.
He's buying the dip. He was buying the dip in Apple. It was a good move. The only thing looming though large is still that 180. Maybe the Buffett push can push us through there today, but I'm still concerned here overall. Just with the 180 level, because it's so major. I mean, January got up there, February got up there. We snuck our head above it in March, got up to 183.50, but that 180 just looms large, and we've come straight from 160. I don't think there's going to be some resistance there, at least the first time around.
We were talking about this yesterday, and you said, hey, if it's going to be like every other stock, it's going to give it back. And I looked at the charts, and I'm like, well, man, it's going to have to show me some weakness first. Absolutely no weakness here. Trading up at the highs of the pre-market session. Your pre-market high is right here at 179.27. Former double top back in middle of April, 17th and 18th, right here at 179. So I'll say holding 179 here is very important for Apple. All-time high is 180. No, it got to 183.50 actually, but after that had a pair of highs just over 180. So let's go 180 and then all-time high at 183.50.
Jump over to our earnings parade here. Not as many stocks reporting here today. Fridays are always lighter days, but there is some key stocks this morning. Alibaba and Celgene are two of those. Alibaba got a big lift on their numbers. It is leaking right now, though, big time. Give us a number, Spencer. Joel talked about that pre-market action.
Q4 EPS for Alibaba, 91 cents. That beat the estimate by 3 cents. Sales, 9.87 billion versus 9.27 billion. So beats on both the top and the bottom for the Q4 numbers. In Alibaba, they do see their fiscal year revenue growth over 60% year over year. They also released some user data. As of the end of the quarter, they had 617 million mobile monthly active users and over 550 million annual active consumers.
Joel, it popped up big. Where did we get up to?
Oh, man. It got over 190. So if you were going to take some heat, because it did go to 191.45, but then couldn't hold that at all. Let's see what this daily high was here. It didn't quite get to the 92.25 high, but I just think when you popped over 190, I think someone just came in with an order and said, sell every bid, hit everything you can until 190. And I think that's I don't even know if we're going to see that in the regular session today.
Well, and I think, as we continue to leak, there is the concern here. It's only up $2 now that you give it all back. So again, we're seeing this trend still, a lot of companies giving it back. Some of the defensive stocks did hold on to their gains yesterday. Kraft Heinz looked like it wanted to give it back. So did Kellogg's, which reported. It looked like it wanted to give it back, but they did hold on to the gains at the end of the day. So you're seeing some of the defensive stocks actually hold on a little bit better than maybe some of the Momo plays when they're reporting there. Let's jump over just to look at Celgene here this morning, because it is not really defensive, but it's been a dog. And I shouldn't say some of the defensive, some of the dogs have held on their gains better than some of the stars of the market, if you will. Celgene was at support, $85. It's up here a couple bucks in the pre-market. Give us a number, Spencer. We'll break it down.
Celgene Q1 EPS $2.05 versus $1.96 estimate. Sales 3.5 versus $3.46 billion. So good numbers. Beats on the EPS and sales for Q1. They did, however, lower their fiscal year EPS guidance by 35 cents on the low end of the range, from $8.70 to $8.45. They raised their sales guidance for the fiscal year slightly as well.
I mean, this is okay. It's an okay quarter here. Is it good enough to hold on to the gains? Maybe. I'm not jumping and doing cartwheels here. It's just a matter of, like Spencer saying, they didn't drop any major bombs. So right, that's maybe why it's not. That's Gilead got destroyed on their report. And, they didn't drop any bombs. So I guess that's good. Stock's got to hold above 85. You don't want to see it give it back.
Yeah, and Adam Feuerstein, who's a friend of the show, Stat News, one of our favorite biotech reporters, and that's his take too, is no blow-ups, not the disaster people feared. So good enough.
Good enough. I mean, these companies make so much money, but I'm telling you, it's just not what this market cares about. The market doesn't care about how much money you're making. It cares about how much you're growing. And when you're not growing the earnings and you're not growing the top line, the market puts you in the doghouse. So, here you got a company that's going to make $8, trading on a multiple of 10. Doesn't matter, if market multiple 16 or 17 is trading with a discount. It's not growing. And, they're trying to buy some growth. They're trying to figure that out. Maybe they will. But right now, if you're not growing the top line, the market has no interest in you whatsoever, which is why a lot of my value stocks are not performing as well as they have in the past.
Pop and a drop. I mean, I sound like a broken record here. You got to pop up to 89, 70. Couldn't even get to the $90 level, buck and a half. Yeah. But, just looking rough. If you get down to 86.59, which looks like a possibility here, that would fill the gap. 85.40 was the close. You certainly don't want to see it go red. And Dennis, if this takes out 84.26, that's the actual low of the move with an 84.30 low, then, you're talking about perhaps seeing $80. I mean, I do see 83.16 as your October 2014 low, but just the trend continues. Selling the pops here in these stocks off good earnings reports.
Yeah, or even off okay earnings reports. Yeah. It just seems like, it almost seems like a strategy this earnings season. Just sell every pop. And you're not going to make it on every single stock, but it seems like 8 out of 10 you're making it on. That they pop up big time and then they give it back, or they give back most of it. I mean, Apple is, obviously, was the case there where it didn't give it back, but Google gave it back. I mean, we saw, Facebook didn't give it back either. So there's been a couple that have held on. But for the most part, it feels like 70 or 80% of these stocks, when they have their initial earnings pop, you look at them and 2 days later, they gave it all back. So it's been a disappointing, we'll say, response to the earnings. The earnings themselves have been okay. It's just the response to the earnings which has been very disappointing. And that's why I'm concerned about the market too. I mean, we aren't rallying. We aren't responding well to pretty good reports. I don't see what's going to take us higher. We're going to get that jobs number at 8:30, though. That is going to be a major market mover here, I think, today. As they look, we were starting to leak big time ahead of it. We just lost about 5 handles since we started the show, really. So.
No.
Yeah, we're starting to leak. People are nervous ahead of these jobs. They just look for excuses to sell. Just like the last few years, they've looked for excuses to buy. This time, they look for excuses to sell. The mentality of this market has changed. That is why I'm concerned about a lot of different charts and a lot of different stocks. The mentality has changed from buy the dip to sell the rip. And I don't know how we get the buy the dip mentality back when buy the dip is not working.
We were talking, I believe, on yesterday's show or Wednesday's show, some of these defense stocks. Lockheed Martin made a new low for the move yesterday, but did rebound to close green. So that has had its first up day since its report. Wow. General Dynamics made a new low for the move, but did battle back to close green on the session.
It was crazy how wicked those moves were on good earnings. A lot of us had good earnings. I mean, Lockheed Martin lost, just going back to that chart, it lost basically, 20% in a week and a half. It was a darling, making a new all-time high on a good report. And boom, a week and a half later, it's 20%. I mean, this is, a long-term, correction that was maybe needed. These stocks just got way overdone, to January, and that was it. We had upside capitulation back in January in so many different issues where, everybody said, I got to buy stocks. I got to be in. These things are going up forever. And we went up 8% in 1 month. And now that's long gone. And now you're looking at everybody who bought, in January is significantly underwater because so many stocks. I mean, you try to find a stock that's trading higher. Apple might be one that is where, higher than it was trading in January, but it's kind of flat to where it was in January. But everything else is in the red. It's been an ugly couple of months.
George in the Google chat is making an interesting point here regarding Buffett and how he stayed away from tech stocks for decades, and now he's buying one of the supposedly the
value tech. He's still doing the same thing. Like Buffett buys stocks on the multiples they're depressed, and Apple's trading on the forward multiple of what, 11 or 12. I mean, you take back the cash out, you probably can get even in that multiple down even further. I mean, it's classic, and I'm following the same suit. It's why Apple's one of the biggest positions in my investment portfolio as well. I mean, it's growth at a reasonable price, but it's not growing nearly as much. But Buffett likes companies that make money. So do I. And I'm sticking with that theme, although this market just doesn't seem to care what the companies make money. It just wants to see top line growth. So it will change. The mentality will change. We will go back to value investing. It cycles. You'll see markets go for a while in a bull run. You see the growth stocks take off. maybe we're going to switch eventually to these value, but we haven't even done a switch yet, because normally when you start seeing all these momos start to sell off a little bit, you start seeing the value stocks catch a bid. But the value stocks cannot catch a bid. I mean, there's so many stocks that, are just making new 52-week lows. I mean, the tobacco stocks, and maybe they got their own problems. They've been absolutely annihilated. Philip Morris, $105 before the report. It's $80. MO, $56 is when it was 65 before before the Philip Morris report, which knocked everything down. And maybe people are going to smoke less and those other issues there, but there's just so many stocks that have been absolutely annihilated. And biotechs too. Biotechs have not been performed well, at least the big bio. So jump over. We got a couple other stocks here that we reported last night that we didn't get to. This was a little bit of a circus show, Spencer. Activision Blizzard, ATVI, came out before the bell, and they weren't supposed to.
Right. Well, they didn't release it before the bell. Dow Jones jumped the gun on the embargo, the earnings embargo, and not only did they report, so the numbers that they released, first of all, weren't even right. They said they said the Q1 EPS was 65 cents versus 35 cents. Sales 1.7 versus 1.32 billion dollars. So the stock halted after that, because those, not only was it obviously during the market hours, wasn't even the right numbers. The corrected number for sales was 1.96 billion, not the not the 1.7 billion that they had originally said. The EPS was 38 cents versus 35 cents, not the original 65 cents versus 35 cents. So that came out, much later, and statements were released, yada, 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 but kind of a mess there. They did also, Activision Blizzard, raise their guidance for the fiscal year.
So raising guidance, the numbers came out and they weren't right, but then they released the real numbers. This is kind of interesting. You can see the crazy action during the day after those numbers came out. Got down to 64, and they halt the stock then for a bit intraday. Yeah,
they halted it,
and then it'll reopen higher. When the real numbers came out, they looked better, but then it's leaking it all back, and now it's back down to where it was, $65. I mean, this stock is a little bit expensive on a multiple. I know the esports thing, and me and Joel talk about esports all the time. We are, very bullish esports. It's just a matter of when you're buying ATVI and EA, you're paying a premium, and I don't, like paying, up, at high multiples for stocks. But I do think, if you're buying these stocks on pullbacks, there's a lot of love for the business that they're in, and they're all moving, obviously into games, and the esports is taking off. That's really, a tailwind for Activision Blizzard. So I think pullbacks are going to be bought on Activision Blizzard. I see a huge support level here too, Joel. Maybe.
Oh man, Spencer, I'm just going to give you guys one.
You can back up the truck.
I'd be careful here. 60. Let's just call it 63.5, 64. Go to the monthly here, Spencer. I mean, listen to your last 5 months of lows. 5 months. 63.37, 63.32. And then you had 445, then 352, and 64.06. So you bulls cannot, hold on to this one. Absolutely 63.50 area. Boom. Another huge leg down. That is I know it's $1.50 away from that, but that is the level of levels in Activision coming up on a rally, big range yesterday. It doesn't look like we're going to see yesterday's high. First things first, this thing has to get green on the session. Yesterday's close 66.82.
I just like that esports stuff. So it's, these are stocks, and there's really only the three big ones to play. Like if you want to, it's Take-Two, TTWO, EA, and Activision Blizzard, ATVI. There's other gaming stocks, and that's a little bit different story. Like the Zyngas, Glue Mobile's another one. I do own Glue Mobile, GLUU, in my investment portfolio. Yeah, I have this one. It's a smaller total speculative play. It's been blasting off. GLUU. Wish I would have, I just put speculative cash in it. When I do speculative plays, so I have a standard amount of money that I typically invest in the stock. When I do a speculative one, I usually put 1/3 or even less of, maybe even 1/4 of what I normally put in. Because, the spec plays really move around a lot. So, I don't want to get destroyed in something. So I put a small position on Glue Mobile a while ago. It's been a good one. It's been straight up. I'm up like 25% in this thing in a month. So I don't know. It's a gaming.
the gaming thing?
Yeah, you look at all these things and you're trying to get exposure. The gaming is just taking off. Like there is so many people, this Twitch and all this other, this gaming stuff. And I find it unbelievable, this esports stuff, Joel. Just that, people will sit and actually watch these video games and pay to watch these video games. I mean, they're filling arenas to watch people play video games. It seems nuts, but the people who are watching this, and I talk to my buddy Pete at Barron's Rings all the time because he's pumped about all this esports stuff. He is saying like these people who watch this stuff are so hardcore. The average fan will watch sports for so long. These esports fans will watch sports like 3 times longer. They're just so hardcore. And he's like, and he's a gamer, so he gets it. He's like, oh, I want to see what they're going to do because maybe I'm going to learn a new move or maybe I'm going to learn this. So you're learning how to play the game better for yourself. So that's why, it's so, hardcore. But are you a gamer, Spencer? Do you play any video games?
No, I mean, I grew up with them, but I don't at the moment. No, I kind of grew out of it.
I did too, and maybe we should know. We should have stuck with it because some people making a lot of money playing these video games for a living now. You get on an esports team.
Some people.
I was pretty dang good at Super Mario 3.
Some people are making a lot of money. Most people are not. And so
there's always that's in anything,
right?
Like normal sports too. Most people who play sports don't make money, but I just find it amazing that you've got some people making, 6 digits a year playing video games. It sounds unbelievable. It sounds unfathomable to me that you could play video games and make a living off of it. But there's some kids doing it. So good for them, and it's an interesting industry. And I mean, those 3 stocks, ATVI, EA, and Take-Two, TTWO, are the ones that obviously benefit the most from. Microsoft too, to a certain extent. I mean, Microsoft has a lot of their business.
There's more to it than that. NVIDIA, all these gamers have extremely high-powered computers.
NVIDIA is a game being played too. 100%.
Right. There are more gaming plays than just those 3, but those are the.
But I was saying the pure plays,
right?
The ones that are actually in the video game business. Those 3 are basically in the video game business.
I'm sticking with pinball. I'm sticking with pinball.
Way to be.
You're a pinball wizard.
Way to be.
He's a pinball wizard.
Yeah, that. No, it's we've been discussing a lot, trying to find some investment opportunities, and
the multiples are so high.
There was a big article in the Free Press about the Pistons sports or esports team or whatever, and the players on it. To me, I couldn't spend 30 seconds watching something, and to pay to watch something like that. But you know what? Times are changing, and it's definitely who was it? Was it Pete that said that like high school, you're gonna have like a high school football team, and you're gonna get a letter jacket because you got a letter in football. Can you believe that?
I mean, it could go to that. Pete's he's a visionary there. He's my buddy at Barron's Rings, and he just talks so highly of esports. He thinks everything is going like this. Esports is like the whole future because he does sport. Like they do championship rings at Barron's, and he did the rings for the Cleveland Cavaliers. So this guy's a player in the industry, like one of the major players in the industry, and he is like just focusing on esports. Like he's like, this is like where it's gonna be. And he's been doing traditional sports for a long time. I mean, we're in Canada, so he gets like obviously all the Canadian contracts, but making rings for the Cleveland Cavaliers, this guy knows the business of ring making, and he's like, this is esports, this is where it's going. So he's pumped. He's got me pumped for it too. And we're just looking at different opportunities with it. I know Kramer talks about esports all the time on Mad Money as well. It's tricky because everybody else knows it too. So there is higher multiples you're paying. But all I'm saying is a stock like Activision Blizzard, when you see it pull back, ATVI, people want to be in this stock because they believe in esports as well. And that's why when I see Activision Blizzard pulling back $6-7, it makes me interested. It's probably not going to go in my investment portfolio because I believe the multiple's too high when I crunch the numbers, and how I am with my value investing. It doesn't really fit the description. I mean, the stock is last up was $10 back in 2013. It's $66 now. So you're definitely chasing here to a certain extent. But I think these stocks continue to go higher over the next few years here because the esports business grows. These guys are positioned in the right industry.
And they must be eating at Shake Shack while they are playing these games here, Spencer. Why don't you give us the Shack report?
All right. Shake Shack reporting yesterday after the bell, they reported Q1 EPS 15 cents versus, this is the adjusted number. We had that debate last week, 15 cents versus 9 cent estimate, sales 99 million versus 97 million, raising their fiscal year guidance, raising their sales outlook by a whopping $2 million. Whoop-de-doo, raising their comps outlook from flat to a as much as 1% increase. Again, this is for the fiscal year. So slight, the ever so slightest of increases on the fiscal year guidance.
Joel, I'll let you take the technicals on this one.
Yeah, just a big pop here, 52.80. That represents your pre-market high. That's a big level because we haven't been over $50 in a long time. If you want to hold out for some more profits, 53.50 was your high in November of 2015. So it's holding the gauge pretty good, but the longer that 52.80 stands as the high, I'd worry about this backing and filling. Just
the one thing, and you know, just about say worrying, but the one thing is, again, they're growing the top line though. And market wants to see top line growth. They don't care. This market still does not care so much about valuation right now. It will change. I'm going to say it will change again. But right now, in the last few years, doesn't care about valuation. We care about growth, top line growth. Shake Shack showing you top line growth. So that's why stock is getting a lot of love here. You know, you put it on value metrics. Warren Buffett's not touching this with a 10-foot pole. But that being said, a lot of people in the market are because they still care about top line growth. So not me. I stick with the Warren Buffett approach. Won't go in my investment portfolio because it's too expensive. But
I mean,
top line growth. So
since
there'll be buyers and pullbacks.
Since the IPO, Dennis, you know, Q1 of 2015, they made $37 million. Q1 of 2018, they made $99 million. So yeah.
So they're growing the bottom line.
They're growing.
And they're growing. They want top line growth and bottom line. They want growth. That's what they want. And
Dennis,
if you're not growing earnings, they do. They throw you in the doghouse and give you a multiple of under 10.
Dennis,
that's what this market does.
Do you want to do one more stock, 827?
No, I'm going to get ready for the stock. I think it's going to be a big number. I need the extra minutes. So you guys jump through. We got all kinds of earnings for you guys. You guys be okay with me without me for 5 minutes because I'm going to trade this job number.
Not really, because you talk the entire show. So I don't know. I don't know what
I talk too much. Are you saying I talk too much?
Why don't we just put the sign up and then 20 to 9, quarter to. Oh, we'll talk to our guest, Dennis. We'll try and find something to do. Spencer, could you preview the jobs number for me, please?
Sure. The question for the month is this the month we finally get at or below 4% unemployment? We've been at 4.1 now for a while. The consensus estimate is that employment will fall a tick to 4%. That'll be the lowest since 2000. So we're waiting to see that as well. The non-farm payroll estimates, 189,000 jobs added last quarter is the consensus estimate. Last month. Remember, 103,000 is what we got at the prior reading. So 189 is what we're looking for in the non-farm payrolls for the month of April. And Joel, anything happening this morning or right now as we speak in the S&Ps?
No one is jumping the gun as of yet. We did sell off to 1950. That was, I had talked at the top of the show about the 2620 area. That's a daily pivot, but that's a weak number. And the reason it's a weak number is because yesterday's low was all the way down at 25.91 and a quarter. So if that low is taken out, what's going to break loose here. So we will keep an eye on it here. We are about 35 seconds before the number. No one is jumping the gun in the S&Ps as of yet. Let's keep an eye on the pre-market high of 34 and a quarter. Let's see, 20 seconds here. Crude hanging up. If crude does go into any kind of rally mode off this, 69.55 has been the high of the move. Gold trading down a couple bucks. Gold has been known to move big off this number as well. We are at, let's see here, 5, 4, 3, 2, 1.
I'm waiting.
They're popping it here a little bit. They're trying to rally the
there we go. 164,000 non-farm is the non-farm number. 164,000 jobs. Remember, 189 or 193 was the estimate, depending on which source you're looking at. So 164 on the non-farm payroll. What do we got on the private? 3.9% unemployment, Brent? Is that what you just said? Wow, 3.9% unemployment. So yes, we did break the 4% unemployment barrier. So we haven't been this low since I think since 99 or earlier. So unemployment beat the estimate. Non-farm again 164 versus the 189 or 193 estimate there. So a little bit lower on the non-farm number.
All right, we're trying. I mean, Dennis is going to be back on pretty soon here because we got some crickets here. We were traded at 26.23 when that number came out. We've gotten a little pop here to 26.27, but that's mid-range on the session, and so far we have not been able to take that out. So I'm going to adjust my numbers here a little bit, and I'm going to say 26.27 is going to be the key to any continued upside. And that pre-market low, 26.19.50, that absolutely have to stand, or John Dotson's finally going to get his much-awaited crack to the February lows. But until that happens, you still have to be leaning towards the upside. Angie Baby, she's betting against the market here along with John Dotson. So we'll see what happens. We are above the mid-range on the session, 28 even, 28 and a quarter. They're liking the number, 29 prints. Pre-market high, 34 and a quarter. So right now the market is getting off the mat. Of course, we'll have to see what happens when the true liquidity comes in at 9:30, but we're bouncing around pretty good. The banks are not bouncing, though. Bank America is still down 8 cents, 18 cents at 29.02. Goldman Sachs is just not moving here, hanging out just in the red here at 41 cents. That made a new low of the move yesterday at 27.40. Apple's maintaining its gains here. Wow, they're not selling Apple off this news. 179.13 up to 19. So
someone in the chat asked about payrolls wages. Wages not growing. Average hourly earnings up 2.6% versus a 2.7% expectation, and that was also the previous reading. So wages just still not a thing, at all. So we'll see if that changes, but that's been a consistent theme. Dennis, are you back with us, or are you still?
Yeah, no, I can be back here. You got to pop. We got to pop on the S&Ps there. We were trading around 6-7 handles. We popped a flat. Banks actually are leaking here a little bit. They kind of did a little whipsaw. You didn't know whether they're going to go up or down. Now they're starting to leak. Bank America's trading down 0.5% here right now. Citigroup's down about 0.5% as well. So you are seeing weakness in the banks here this morning. So maybe they think interest rates aren't, going up as quickly as they thought before. But it's really kind of a little bit what Joel said. It's a little more crickets. This is not the kind of move we were seeing a month ago on the jobs number. This is kind of muted response here. I mean, we popped 6 handles, but not a lot of opportunity here on this number.
All right. Someone just mentioned here the TLT that's trading up 43 cents. Still, I mean, the overall trend has been down in this one, but really trying to find a bottom here. 116.49 has been the low of the move. If you're trading the TLT, keep an eye on 122.40. 3 highs, all in the same area. Not yesterday, but on Monday, Tuesday, and Wednesday. Let's just call it 122.40. Major resistance in the TLT, but you're still a couple bucks away from that. All right, Spencer, you want to go grab our first and only guest of the day?
Yeah, we should go do that. Steve Sears, longtime columnist at Barron's, also an author, now at a new firm, Stratifi. We're going to ask him about his role there. We'll be right back with Steve Sears. Welcome back, everyone, to Benzinga's Pre-Market Prep. Spencer Israel, Joel Elconin, and Dennis Stick on now with Steve Sears, long-time columnist at Barron's, now with the new firm Stratifi. We're going to ask him about that new firm and his new role there in a second. Steve, how's it going this morning?
Fantastic. How are you guys doing?
Well, we're doing good here. We're just looking at a jobs number, getting a little pop up off that. But first let's go into your new employment here, working for Stratifi Technologies. I think you maybe hinted at it last time you were on the show. Tell us about what you're doing, how you're helping out advisors.
Well, Stratifi Technologies basically embodies everything I championed in my column in my book. And what we're trying to do is trying to help advisors and investors define and manage the risk in their portfolios. Too many people think that some sort of combination of bonds and stocks basically reduces risk, but it really doesn't. And I think one of the things that's happened since the financial crisis is a lot of people realize that they don't really know what they own. What they think they own is not what they own. And they're kind of worried about managing, downside risk or tamping out some of the volatility. And that's what I'm involved in as a chief market strategist. I get to talk to a lot of different people. We have a risk measurement tool called Prism that allows that advisors can upload a client's account into. It'll push out a risk score from 1 to 10, 10 being the riskiest. Then it makes some suggestions for a variety of solutions that could reduce risk and manage risk and change the whole profile. We could do that not only for an investor's account, but also for an advisor's entire practice. So it's kind of exciting.
All right, I gotta ask you. I mean, just overall here, we're going through a lot of charts here, earnings related or non-earnings related, and boy, there's very few stocks here that are looking good on the charts. In fact, some of them look downright awful. The defense stocks got hit very hard off their reports. Don't tell me the banks had good earnings reports. Those are way below the year lows for the year. Just overall, what's the sentiment out there? Are these advisors, are they getting some heat from their clients? They're like, hey, maybe it's time to ring the register here and just take some chips off the table.
I think a lot of it depends, obviously, by advisor size and by account size. And
okay.
What we are seeing is that as the baby boomers age, the one big topic of discussion is that from this year is supposed to be the first year that the baby boomers are all required to take out minimum distributions from their retirement accounts. And so there's a lot of concern about the pressure that's going to have on the market. I'm hearing that from the hedge fund community for the first time ever. But the individual investors are looking at these things and going, oh my God, I depend on this account to fund my retirement, to fund education for my kids, whatever it is. And they're worried about it because a lot of things don't make sense. The banks did have good earnings. Rates are rising. Look at Bank of America, which is hovering just below 30. Out of all the U.S. banks, that one is the most levered to rising rates, and the stock is probably stalled to negative on the year. Take it through the financial sector, you see the same thing: utilities, REITs, everything like that. Now, some people will say that that's due to they're rate sensitive or they're defensive, but these blue chip divvy stocks that have held up so well over the past decade are starting to stall as these macro concerns, which the jobs number really epitomizes, start to re-exert themselves again in a major way. So there's confusion.
Steve, explain the Prism rating system.
Prism rating system basically does about 200 calculations underneath the hood, and what it does is it measures things that are really important to investor stability. It measures volatility exposure, correlation exposure, tail risk exposure, and things like that. And it becomes a very simple number that anybody can understand. Because let's face it, when you're talking about volatility risk or correlation risk, you're starting to go into more advanced or potentially more complicated investment ideas. So by expressing it in a single number, it's a way for advisors and investors to begin to have this kind of important conversation about what they own. It takes it beyond buy stock X for this thesis or sell stock Y for this thesis, and gives this holistic view of the portfolio. Look, it's the way the institutions have long approached investing. You gentlemen know as well as I do that nobody just buys a stock in the institutional level, either without a plan to sell it or without having some sort of hedge around the trade. It just doesn't exist that way in the individual marketplace. It should.
So I assume then that each, because the Prism, rating, it gives you a number on a scale. I assume that's different for everyone because everyone has different risk tolerances.
Oh yeah. So it's customized for each account. It's based on whatever the holdings are, and it just it does about 200 calculations.
And so is say again who this is for? It's for institutional and retail?
No, it's for. We believe that there's a great need within the financial advisor community for institutional quality risk management tools. They don't really exist that well. Of course, BlackRock does this at the institutional level with Aladdin, but nothing exists for these advisors. And so what's happening is many advisors are leaving the wirehouses and they're going independent. And when they do that, they basically have to recreate their own worlds. So what we're trying to position ourselves as in our Prism product is that sort of institutional risk management aid to help them better understand the portfolios.
All right, bringing it back to the markets. Then Joel just kind of asked you about just mentioned that so many charts are looking weak. Are there any areas that you are liking?
You know what? It's pretty difficult. I think that they're just massive question marks now on almost everything. I still like the financials if you can hold them for a long time. I think they're pretty reasonably priced relative to book, and they're pretty good companies. Same thing with the REITs. REITs are under a ton of pressure this year, but if you can find good quality dirt underneath them, those are always good names. And it's hard not to like. This isn't sexy at all. Some of the big pharma companies with the aging of America, those stocks are thematically well positioned to perform over time.
Steve, Dennis Dick here, and you're talking my portfolio here right now. Obviously, I'm a prop trader, but I've also got a long-term investment portfolio, and I've always taken the Warren Buffett approach, which is more like value investing, looking, when stocks are on sale, buying low, selling high. It seems like this market likes to buy high and try to sell higher. This value investing has been out of favor, I can tell you, just from my own portfolio for the last few years, because everybody, all they care about seems like is top line growth. They don't care if, you're paying a high multiple. You see stocks like Shack take off this morning because they're growing earnings and they're growing their top line, not really so much earnings, but they're growing the top line. It seems like that's all the market cares about. Do you see that cycle changing here in the near future? Well, do you think, what are your thoughts here of this, value investing being out of favor?
I think that the growth investing still entrances most everybody. And this is very true for a lot of people who are conditioned to trade from quarter to quarter. And there's a lot of good growth stocks out there. Like Alibaba was trading much higher in the last time I checked, on positive earnings.
Yeah, it's giving it back.
But I think the value investing stuff is always, if you can buy a quality stock worth X and you can buy it at a discount, do it. But I think the problem is that too many people don't have the resources or the constitution to practice value investing. And there's their own psychology, frankly, I think works against them oftentimes. Everyone's so conditioned by technology now for these super fast returns, and value investing can be a bit like aging wine. It takes time.
So you think I'm still going to be okay with some of these biotechs? I started to question myself after I've been doing it 18 years, and I've had some ugly periods here, but this one in the last few years, I've definitely underperformed the market. I'm like banging myself on the head as I see, my Celgene stock keep coming down. It's trading, it's going to make $8.50 already anticipating next year, trading with a multiple of 9 yet, the stock just, here it is, okay report, and it's already starting to leak again. It just seems like stocks just can't catch a bid.
I think you have to have a stylistic blend, frankly, and approach it that way. I think one of the big lessons for me from the credit crisis was that the people who could afford to marinate positions, they were basically value investors who could see things and see worth where others didn't, and have the ability to finance it, did phenomenally, and they caught turns. I guess the bigger question is, do we think that the market is turning here? I happen to be at the options industry conference in Amelia Island. And this is the huge question amongst all the traders that are down here. and the risk managers, they're wondering if the markets are going to turn. You know, if inflation came in, I think at 2% earlier in the week, which is probably the first time in ages. That, of course, is the Federal Reserve's inflation target. And if inflation runs hotter, the fear is that there'll be more interest rate hikes. And if there are more interest rate hikes and the 10-year yield goes above 3%, that's something that poses quite a bit of pressure, of course, for stocks, as we've seen recently. So I think like a lot of guys are just like deer in headlights watching these things. And so the jobs numbers come out today, and that's a huge indicator for them as well, because if the jobs are too good, it means the economy is running too hot. And if the economy is running too hot, it means inflation is running too hot, and then they may have to raise rates. So I basically think that these macro issues, which are pretty oblique, are what are pacing the game, quite frankly.
All right, Steve, got one more here for you before I let you go. Just being a longtime reader of your column, you've talked a lot about a lot of different stocks and how to position yourselves, how to get into them. Sometimes you talk about outright call positions. Other times you talk about selling puts or selling put spreads. Which you need a lot more money in your account to do. In this market environment, are you, more apt to perhaps go on the call side or the call spread side and, have your limited loss? Or, are you still, looking at the game where, selling those leaves and those out of the money puts and, perhaps doing a lower put to lock in the spread? Are you favoring either strategy now in this market environment?
I'm still a huge fan of the cash secured put right, or selling a naked put if you have the wherewithal to do it. I mean, I guess that's the options guy's way of doing value investing. There's a lot of solid names out there, but there's confusion and static, and a lot of these things are range bound. Figure out the range. If you want to buy it, sell the put. That strategy has outperformed a buy and hold investing. According to a variety of studies.
Really?
All right.
That's interesting.
We've on the line with Steve Sears, Chief Market Strategist at Stratifi Technology. Steve, thanks so much for the time today, and have a good weekend.
Thanks, guys. Thanks for having me on.
Thanks, dude.
All right, where are we at?
Interesting what he just said there. That the obviously we have Nick Shaheen who preaches and this strategy. The put right there. On Tuesdays we have Nick Shaheen every Tuesday. But it's just interesting that he said there's studies out there that are proving that over the long run that the put right is better, outperforming buy and hold. Obviously I'm a big buy and hold guy. The one reason why I've never been a big fan of the put right, and maybe I should start looking into it. And he's saying the covered put right, like not writing more than you can afford to buy. And I kind of get it. Like you're always writing puts that are out of the money. So, probably 8 out of 10 times you're never going to get, where you have to actually buy the stock. You're just going to collect that premium. So you're always kind of writing insurance to the market, which, in the long run, we know insurance companies can make money. The one downside with that is if you really get into an ugly market, you get put a lot of stocks, and obviously you're only, really the only thing you're taking in is those premiums. So you're kind of still obviously taking on risk and not getting quite as much of the return, because if you flat out buy the stock, it goes up, you make money. If you flat out buy the stock, in the put right scenario, you only keep the premium. So that's why I've always, just if I like the stock, I just buy the stock. But it's interesting. I guess if you're rating significantly out of the money, like, Nick Shaheen would say, you look at something like Apple. If you would buy Apple at $150, why not write the put there? And, if it goes by, if it goes down there, you're going to end up buying it. But, the one trouble that people get themselves into is that they just write more than they can afford to chew on. And if you're writing, a massive amount of puts and you don't have the margin or the money to come up with in the event, that we really go into a nosedive in the market, you could blow out your account doing stuff like that. So that's why he likes the covered put right, where you've got the cash to actually do this. So maybe it's something I should start looking into more.
It's the thing about it, and Nick stresses this quite a bit, is that with selling the put or the put spread, you don't necessarily have to have the stock go up. Because
it can just stay flat and you make money.
You can stay
or even
flat.
down slightly.
Yeah. Exactly. Some of the
Time's on your side.
Yeah, it depends on that. And then I'm also sure that, the clients or the advisors that they talk to, I mean, if they're doing that, those sophisticated strategies, I'm sure they're having some overall put coverage too, in case you have one of these, major collapses in the market.
Well, that's why Nick Shaheen does it the right way. And, he'll buy the 150 or sell the 150 put on Apple, but buy like the 140 or the 135 just in case, we really go into no. And that gives the opportunity to do a little bit more, size than you would otherwise. Because if you just leave it wide open, you obviously got to, protect yourself from having the capital to do it, but you don't even have to be completely covered if you're going to protect yourself. So, that's why he's always a fan of the naked, of not writing them naked, but, doing the put spreads. So it's got great strategies, proven strategies.
Have we covered all the earnings? Do we want to do a little bit of ratings here at 854? I just mentioned S&Ps went down to 1675, and I'd be lying if I told you I had a level there. I don't. We bounced. 26 of 25 and a half is mid-range on the session. So we keep an eye. It's trying. I mean, it's just even if you're a bear and like Mr. Dodson is here, I mean, these dips, like that dip yesterday, you might have thought, wow, we broke the 200-day moving average. We're under 2,600. We're just going to plow this market into the ground, right? Yeah. And what does it do? It rallies 40 handles right in your face. So it's not easy being a bull or a bear. Let's see here. Spencer, are we done with earnings? We want to do a couple ratings.
I wanted to do Virtu Financial, VIR.
Oh, yeah.
I had a feeling.
Trading firm. I didn't see it on the list to report because I had it written down that I wanted to buy Virtu ahead of the report just because I figured they're going to blow the numbers away because I had my best trading quarter in probably 7 years. Just because of the increased volatility. So I can pretty much guarantee you Virtu Financial was going to have one of their best quarters in the last 7 years because we're running similar stuff, although they're doing the high frequency, they're doing a little bit higher level, but it's all VIX. I mean, when you're, a short-term trader, and, providing liquidity and market making strategies, when that VIX goes up, you're just making more money.
Yeah, I had a feeling you were going to want to touch on Virtu. Ticker VIRT, Q1 EPS 76 cents versus a 52-cent estimate. Sales $815 million. Same quarter last year, $147 million. So, yeah, that's some year-over-year growth right there.
And they got the night, obviously, in there that's helping them as well. The KCG numbers would be in there. I don't believe they were in there a year ago because they got that merger there. But you just know, like this stock, you can look at it, and the increased volatility does wonders for it. And you can look at it, and, you can say, well, wow, those are a fantastic report. Why is it not up higher? I think, Wall Street probably sitting there like me and saying, I guess, this was going to blow it away. You knew it was going to have a hell of a quarter because every trading firm did, at least prop firm did. So, here it is. It's actually trading flat here now. Not buying it for that reason. And this thing is up a long ways. And I kick myself every day because, Eric Hunsader had this one, he tweets about it and he still got it. I had it in my investment portfolio. I had a nice position in it. And I sold it out way too soon, and the thing has just continued to rocket up. I guess, we kind of predicted the VIX, exploding like it did, but as soon as it started exploding, the VIX, this thing took off.
Yeah, Dennis,
Wall Street smart. Wall Street smart. They knew Virtu Financial was going to make a lot of money.
And they are getting out of it. It got to $39.30, Dennis. It was $3.30 higher than where it's trading now. So quiet consolidation here. Really need to get above. I'm going to throw out that pre-market action. I'm just going to tell you folks that 36.50 is huge resistance in here. That was the triple top. So let's keep an eye on that on Virtu. We got 3 minutes left here.
Let's do a couple things.
Talk a little Kentucky Derby?
First, let's do imbalances. Then we'll do the Derby.
Okay.
They are small here today, so you're not getting any information really from the imbalances. I'm actually trying to scramble to find any. Merck, 51,000 to sell, somewhat significant there. Twitter, 129,000 to sell. Twitter had its own little story there after the bell. They came out, and that stock got hit for $1 on this news, but bounced right back. There was a little glitch that they found or something. Spencer, do you got that in front of you?
Yeah.
Some little glitch came out. What was it?
They use a common technology for their password storage, and there was a glitch in that, but they fixed it, and they just advised everyone to change your Twitter password if you use Twitter.
Yeah,
that was it.
I haven't done that yet, so I better change my Twitter password. They advise, but nobody just says ignore.
No, of course not.
Alibaba 91,000 to sell. It could change a lot. It's up $1.75 still. It gave it all back. It's starting to bounce here a little bit still too. That number is going to change actively. I mean, the stock has traded a ton of volume already. It's already traded 4.7 million. So 91,000 is basically nothing when you're doing that kind of volume, but it is a sell and bounce, just to note. That's pretty much the bulk of it. Joel, what did you want to talk? Oh, the Derby. Oh, the
yes.
Derby.
Yep.
The Derby.
Yep.
We only gave you a minute for the Derby. We'll have to go over a little bit.
Okay.
Give us your Derby picks. I'm writing them down because I know nothing about horses, and Joel is pretty good. So I'm going to just pick his horse.
Okay. All right. Let me break it down first here. And Fuzzy's mentioning Bob Baffert, and he's the trainer of Justify, the winner of the Santa Anita Derby. He's most likely going to be your favorite, right? The Curse of the Apollo. Only one 2-year-old, unraced 2-year-old, has won the Derby, and that was in 1882. So Justify did not race as a 2-year-old. So he's going against some big odds there. Actually, the next 61 horses that were in the same position did not win the Derby. That's the same for another favorite there, which will be Magnum Moon, which is trained by Todd Pletcher, who has 4 horses in the race, wink, wink. But once again, this horse had an impressive wire-to-wire victory in the Arkansas Derby, but he's unraced as a 2-year-old, and he has a number 16 post position. Another potential favorite, Mendelssohn, the winner of the $2 million United Arab Emirates Derby. He won by a wide margin, but he was not in with tough company. Also, no horse that has ever won the UAE Derby has replicated that feat in the Kentucky Derby. So if I'm laying off the chalk or the potential chalk, who am I going with? I'm going with Audible. That horse won the Florida Derby, had a sluggish start, was almost dead last, and came back to rally in the last part of the stretch and won in impressive fashion. I'm hoping to get 6, 7, maybe 8 to 1 on him. I also like his jockey, Javier Castellano. He was the top jockey in purse money for 4 straight years, and he has a number 5 post. So let me set the race up for you, folks. He's going to move Audible kind of near the top, and what he's going to try and do is he's going to try and hang out Justified, Magnum Moon, the other horses, make them work to get to the top. He'll settle in 4th or 5th at the quarter, the half, to 3/4. They make that turn coming home. Hopefully he's still inside, and he has that same kind of kick that he had in the Florida Derby to win that. If you're looking for some long shots, Noble Indy, another top Pletcher entry, won the Louisiana Derby, and Vino Rosso, another Pletcher entry, has the number 18 post. And I saw Angie Baby mentioned Good Magic. He was the 2-year-old champion, but hasn't had real impressive races as a 3-year-old. So, and I also just saw something here, Audible. Amazon is backing Audible. I don't know what they're doing. For some reason, they are doing a campaign and supporting this horse. So he has an Instagram account with 177,000 followers. And I'll be having a Mick julep and cheering for Audible.
So give us your pick. Who do you think's winning the race?
He said Audible.
Audible.
He said Audible.
There was a lot of information there, and I'm kind of get lost because I obviously don't follow the horses as closely as you do, or at all. So Audible is who you think is going to win this.
Yes.
And what's the odds on Audible?
I mean, he's like 7, 8 to 1 on the.
Well, that's pretty good payout, though.
Yeah, but I mean, last year I picked Always Dreaming, and I thought I was going to get 7, 8 to 1, and he went off the favorite. So you never know where the money's going to go. But I'm cheering for Audible.
Wait, Joel, the reason Amazon is backing Audible is because they have a subsidiary, Audible.com, right? And
that's right.
And they have
I just saw the tweet.
And it's just a coincidence that it was named that way. All right.
Yeah, if Audible wins the Kentucky Derby, we'll give away free American Pharaoh audiobooks to everyone in the U.S. Is what it said.
All right. Thanks for that, Amazon. All right. Audible is Joel's pick. What time was the Derby, Joel?
Spencer Israel's pick.
Dude, I don't know.
I don't know who else is racing. So I heard all this stuff, but I have no idea.
Hey, just yesterday I learned that you from Joel that you can't be older than 2 and race in the Derby. I never realized that before. I guess that's why there's no repeat winners. But Joel, what time is the Derby at? 6?
I mean, they say the actual post is like 6:35, but they kind of jack it around, so it might be 6:37, 6:38. But you gotta tune in and watch the pre-race stuff, because there's some real good stories on it, and we'll see. I'm hoping to cash a few tickets.
All right, folks. On that note, we are going to wrap for the week. So that's our show for the day. Hope you guys enjoyed it. Thanks to our guest Steve Sears. I want to remind you folks, the Benzinga FinTech Awards is just about a week away now. If you want to get a discounted ticket, go to benzingafintech.awards.com. Enter the promo code PMPVIP. That will get you a discounted ticket to the Benzinga FinTech Awards May 15th and 16th and New World stages in Manhattan. Thanks to all of you who joined us today in our chats. Hope you all have a good rest of your day and a good weekend. We will see you folks on Monday.